So I'm sure you, like me, are seeing so many videos all over YouTube talking about why it's a great time now to be buying the dip. Now this is nothing new. I have been seeing them for the last 6 months across various stocks and cryptos. Clearly, over the same period of time, many of these growth stocks have fallen further, and so unless part of a planned dollar cost averaging program, many are probably panicking a little now about how much further things can actually fall. Now there are loads of narratives at play here, but personally I don't think this is yet the dip which anyone should be buying. In fact, this is mainly a narrative amongst growth-focused investors, which we know is a function of the inflation fears. When inflation increases, it results in a depreciation of the value of money in the future. The majority of earnings generated by growth stocks will be in the future, so increased inflation makes these resultingly worth less. It's really that simple. What we have seen though is somewhat of a rotation, with the movement of capital and money from certain stocks into others, predominantly from higher growth ones into more resilient, stable sectors with lower growth prospects. Now yes, there is a certain bit of allocation across asset classes, but we haven't seen this enormously so yet. A real dip would be a market-wide withdrawal of capital across the entire equity market, and we would see this reflected in all indexes, not just amongst the higher beta stocks as we are now, and it would be a daily double-digit percentage movement, not just a couple of percent here and there. Clearly, the market has reacted and has priced in some of the anticipated interest rate increases in response to the inflation fears we're currently seeing, but that has driven a rotation into stocks with a greater present value and less growth. What isn't yet reflected in any valuations is a potential reduction of the Fed balance sheet. Now looking back at previous periods of higher than target inflation, we know that whilst there is some of this priced in ahead of time, when the rate hikes occur themselves and when balance sheet reduction commences, there is a further impact on stock prices. Personally, I think this is what will mark the actual dip, and I think we will see it for a more extended period of time, at least over a couple of months, as we have done historically. This is not a quick dip and then a recovery that we saw with the COVID market crash, and so I do believe the dynamics will be most like the stock market corrections we've seen historically, as we're potentially entering a recessionary period or a period with higher inflation concerns, with prices depressed for some period of time, likely over a number of months or potentially years. Now the truly million-dollar question is, where is the bottom? This is a really tough question, but something which I've spent a bunch of time analysing in an attempt to position my portfolio optimally. Now, in coming to my answer, I've assessed the current situation in detail and then subsequently looked back at the market corrections over the last 70 years. Now, the first thing to establish about the current inflationary dynamic is that firstly, this is inflation driven by supply-side dynamics rather than demand-side ones. Said differently, challenges with supply chains as a result of the pandemic have caused the current higher levels of inflation, rather than when inflation is driven by demand. This is important because interest rates, the tool the Fed have to control inflation, is really most effective in controlling inflation in demand-driven situations. They're less effective in supply-side driven inflationary environments. Increasing interest rates increases the propensity for consumers to save and decreases their propensity to spend, which ultimately tempers demand-side inflation. This current inflation is supply-side driven, so there is already a question mark over how effective these measures will be. Now the next dynamic to keep in mind is the labour market. Firstly, from the perspective of the level of unemployment, which at present is very low. A slowdown in growth is likely to increase unemployment, which in turn will further reduce growth and will result in a reduction in demand. Now the second important consideration around the labour market, however, is the participation rate and the competition of that participation. Said in more simple terms, the number of people leaving the workforce is increasing, but this is primarily wealthier consumers from the baby boomer generation. They are being replaced by less wealthy millennials who are entering the workforce. Now the impact of those wealthier consumers leaving the workforce and entering retirement is a lower level of consumption from them, and again this impacts growth and inflation. Now some of the initial signs of this are already starting to show in the Purchasing Manufacturers Index and in initial retail sales, so those are definitely things to be keeping an eye on. Now the next dynamic to keep in mind is that in every period historically, where inflation has been above target levels, as it is now, that the market has expected and priced in a certain number of interest rate increases. In every one of these situations since 1963, once the rate hikes have commenced, there's been a growth scare. And by this I mean the previously anticipated growth is overestimated and not achieved, and this looks more fragile than previously thought. In all of these situations, the full number of rate hikes have not been delivered as expected. As such, while we know that we cannot rely on history to give us the answer, looking at history and the current leading edge indicators, we can get a pretty good sense and feel for what may happen. I'm increasingly of the belief that we will see one, maybe two interest rate increases, and then we will have this growth scare, when consumers are not spending as they were, and suddenly the inflation fears wane somewhat. We know at this point in time when this happens, the other rate hikes get put on ice, and investors flow back into the highest beta stocks, the growth stocks, and there's a market rally focused here. The key indicators which I will be focusing on are the bond market, the GDP prints, and the inflation figures. I'll carefully be watching the market and looking for when things look like they're normalising somewhat, and I'll be sure to capitalise on this opportunity. Sure, timing the market is nearly impossible, but armed with the intel, the data, and the knowledge, one can certainly work towards a more optimal entry point. Mark my words, there'll still be a bunch of fear in the market, but that is where real game-changing returns are made and where the best investors make consistent long-term returns. Clearly, the Russia-Ukraine conflict and any other COVID variants potentially blow this out the window, but of course I'll monitor those closely and update everyone as necessary. Also, any significant balance sheet reduction exercises by the Fed clearly also put this thesis to test and would hit all risk assets and investments too, but personally I don't think this is on the horizon currently, but again, let's see. Anyway, thanks for watching, I hope you enjoyed the video. If you did, please smash the like button, subscribe if you aren't already, and check out the Patreon for the private Discord. As always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.